Hey everyone, Cameron Lombardi back here with another stock market investing video. Today we're going to be taking a look at my covered call position on Google and how the stock has been moving over the last week since I've sold the call. If you've been following along on my channel, I've been selling covered calls on Google over the last couple weeks to collect passive income on my underlying holdings of the stock. Before we get too far into the video, if you wouldn't mind to take a quick second to hit that like button below, it really does help the video reach more people and in turn helps the channel grow. If you have any questions or comments, please leave them below in the comment section. And lastly, if you'd like to get started on building a stock portfolio of your own, click that first link in the description to sign up for Robinhood. It's a super user-friendly brokerage where you can easily start investing, and by following that link, you'll earn yourself a free stock to get started. All right, so let's take a look at my position on Google and how it's been moving. So if we go here and click on Google stock, I'm going to scroll down and you can see my position. So I have 100 shares of Google at an average price of $107.71 a share. The current stock price is $111.51 a share. So if we scroll back down, you can see I'm currently up about $384. It's going to keep changing because the stock's moving right now, but I'm up a good amount on my shares, right? Now, I sold a covered call with a strike price of $108, and you can see that here. And this means that I've agreed to sell my shares at $108 a share if the stock reaches and stays above that price and it expires on Friday, May 12th at 4 p.m. So if when the stock market closes on this Friday, if it's above that $108 strike price that I chose, my shares are going to get called away at that price. So anything past $108, I'm not going to make any of that money that the stock has risen. So that's a risk that you take when you sell a covered call, and you have to be happy with that profit at the time of selling the covered call. So at that time, I got paid a premium of $79 to sell the call. So what that in turn means is my break-even price is $108.79 because I'm obligated to sell the stock at $108, but I got paid the $79 to do so. So it's currently Wednesday afternoon and Google is above my strike price, meaning if it stays there, all of my shares will get called away at $108 a share at the end of the day on Friday. So I have a couple of different options that I can do here with this position to manage it. The first option is I can buy my call back for a loss and then roll it out to a further date. But if I do this, I need to make sure that I'm receiving more money in premium than I'm paying to buy back the call option. So right now, if I were to go back in and buy this call, the value of it is $395, and I only got paid $79 for it. So that becomes pretty expensive to do so. It's over $300. And if we take a look at some further dates here, selling a call, I'm not really going to make that much money back unless I roll it out maybe a month or so. So that's not really an ideal option for me. And right now, there's a lot of hype surrounding Google stock. As I'm speaking, there's currently the Google I/O event that's going on, and they're talking about all of the new AI advancements that they're going to be including in the company and working with all of their current applications. And honestly, it all sounds amazing, and I definitely want to continue to be an owner of Google stock. So I want to hold my shares or at least keep trading Google stock, which brings me to my next option I can do. Okay, so if we go back into trade options, let's say my shares do get called away on Friday at that $108 strike price, right? The stock stays above that strike price and my shares are gone. At the start of next week, what I can do is go back into the options chain and I can look to sell a put on Google. And what that means is I'm agreeing to buy back Google stock at the strike price that I choose. So if I were to go down here, and again, this is for next week right now, and look at the $108 or $107 puts, I'm going to get paid $75 for the $108 or the $56 for the $107. And what that means is I'm getting paid to agree to buy back my shares of Google at that price. And if Google is at or below that price at the end of next week, that means I'm going to go ahead and buy back my shares. And again, I'm getting paid that premium to do so. So this is how you can re-enter a position after your shares get called away when you're selling a covered call. And again, right now, the price of Google is hyped up a little bit. It's over $111. I think that over the next couple of days, it might trickle down just a little bit. And if I want to roll this position or just let it expire and sell a put the next week, I think I'll be able to do so. And I may be even able to average down a little bit on that $107.71 average price that I have right now. If it comes back down to around $109 or so a share, I can probably sell a nice cash secured put around that $108, $107 range and get paid to do so. So this strategy of selling covered calls and selling cash secured puts on an underlying stock that you own or want to own is called the wheel strategy. You can use this strategy to generate passive income by getting paid to sell options and getting paid a premium each time. By doing this each week or each month, you can get a considerable return on your investment over time. If you look at Google stock price over the past year, you can see it really hasn't changed all that much, right? It's down about 3.8%. But if during this time you were selling covered calls and cash secured puts, you would have earned a considerable amount in premium from selling options. This is honestly exactly what you want to see when you're wheeling a stock. It really doesn't move all that much, and at any given time, it's kind of staying around an average price, right? So it does have a decent range here from 86, 85 up to 122. But there has been no crazy sudden movements. And if you would have just held this and kept doing that strategy over the past year, you would actually have earned money and not been down on the stock as if you were just holding it. Over time, the goal is to use this premium that you collect from selling these options to enter into more position or add more shares of the stocks you want to own, and then begin doing this strategy with other stocks as well. This will generate you a considerable amount of passive income over time on the stocks that you own, and you can eventually use this as an income stream or just extra money to keep growing your investment portfolio. So I'll keep you guys updated on this trade and any more trades that I'll be making in the future. If you guys found this video helpful, definitely leave a comment below and let me know, and share the video with anyone you think might find this helpful. Thank you all so much for watching, and I'll see you in the next one.